Good afternoon and a very warm welcome to the Shankara Building Products Limited analyst call. I have with me Mr. Alex Verghese, our CFO, Mr. Demerger Srinivas, Vice President, and Mr. Giridhar Parthasarathy, our Manager Finance. We have uploaded a detailed presentation on the exchanges and I hope all of you have had an opportunity to go through it. We are happy to inform you that your company has announced a demerger of its building material marketplace on one hand and the manufacturing business on the other. With this demerger, our building materials marketplace, which houses our retail, trading and distribution businesses, will be moved to a new entity, Shankara Building Products Limited. In our company's history, the building materials marketplace has consistently been a driver of value. The existing entity, Shankara Building Products Limited, is going to house our manufacturing businesses. The manufacturing entity has an extensive network of processing facilities across South India, which are currently underutilized. The demerger presents a unique opportunity to optimize this entity by establishing a focused team dedicated to maximizing the capacity utilization of these assets. Operating independently, this team will chart a strategic growth path, optimizing supply chain management through improved vendor relations, enhanced logistics, and faster manufacturing turnarounds. This targeted approach is expected to drive operational efficiency and enhance market competitiveness for the manufacturing entity. In consideration of the demerger, all our shareholders will be getting one share each for the new entity, Shankara Building Products Limited, and both these entities will be separately listed in the exchanges, thus unlocking value of our high-return marketplace business. To give you a larger rationale of this transaction, Shankara Building Products was established in 1995 initially as a steel distribution company. Over the years, we have strategically transitioned into retail operations and subsequently introduced non-steel products to become a total building materials solution company. As we have progressed, steel dynamics have changed very significantly. More importantly, steel prices have been volatile over the years. This has impacted our margins as well as the working capital requirements on the manufacturing side. So we strategically scaled down our manufacturing business in the past to focus towards our marketplace model. As a result, we achieved good success towards balance sheet strengthening. Our working capital requirement came down significantly from 50 to 60 days earlier to around 30 days. We have seen a healthy growth in our top line as well as our bottom line over the past 1.5–2 years as we focus on our marketplace business. However, the blended profitability margins continue to remain around 3%. The overall return indicators improved to 15% in FY 2023. These returns could have been in the range of 25 to 30% for the marketplace business, but remain subdued due to high capital employed in the manufacturing business. With this demerger, our business structure will be simplified. Our profit margins and return indicators present a clear view of the strength of our marketplace business. The demerger will enable us towards a focused capital allocation strategy. Fourthly, we have decided to augment by bringing a new generation managers to lead from the front the marketplace business and focus more towards value-added avenues. A dedicated management team is being instituted for the manufacturing business. There is a need to explore potential ways to turn around the manufacturing by expanding our product range, identifying value-accretive products, and improving capacity utilization. Hence, we are confident that this demerger will significantly benefit all our stakeholders. The next steps of this scheme of arrangement would be regulatory, shareholders, creditors, and stock exchange approvals. We expect that all the approvals which I have talked about, would get done in about 10 to 14 months from now. With this, I would like to hand over the call to Mr. Dhananjay Srinivas, who will talk on the strategy going ahead.
Good afternoon, everyone. I am pleased as we embark on our new journey with a focused entity for our building materials marketplace business. Over these years, our organization has evolved into an omni-channel path where we cater all types of customers from retail to contractors, builders, influencers and OEMs to all types of building materials from steel tubes, pipes to TMT, roofing sheets, sanitary, tiles and all other building materials through our various modes from our stores, our warehouses, through phone and e-commerce. With this demerger, we aim to segregate our marketplace and manufacturing verticals. We have taken a strategic decision towards shifting our focus towards more value-added opportunities. Our steel trading business has an EBITDA margin of around 3 to 3.5%, while our non-steel EBITDA is around 5 to 5.5%. Our intention is to augment the value we provide by concentrating more on value-added offerings, emphasizing their significance over some of the legacy non-value-added segments. We have taken a few key initiatives to drive the expansion of our non-steel products. Firstly, being the launch of our private label Fosha Ceramica, designed to meet diverse customer requirements within the tile segment. During FY 2023, which was our first year of launch, we have already seen good success in the Kerala market, with a top line of around 70 crores for the year. We have now introduced the brand across Karnataka, Tamil Nadu, Maharashtra and other southern regions in this fiscal. We are in the process of setting up a state-of-the-art display center and experience in Morbi, which is one of the leading tile hubs of the country. This will help us expand our presence to other parts of the country. We believe Fosha Ceramica can play a pivotal role in our non-steel growth journey in the coming years. Moreover, we have strengthened our brand relations and we continue to add premium brands across categories of sanitary ware, paints, hardware and accessories. For example, brands such as Grohe, Duravit, Hansgrohe and Kohler have been added in our sanitary ware segment. We have recently launched modular kitchens and wardrobes in the Chennai and Mysore markets. We have seen good success this year in the hardware category with Hapley, and we are looking to add more reputed brands in the future. While we continue to increase our non-steel mix, we further wish to utilize our strength in steel products, adding value-added products to drive better margins. As we pursue this objective, our analysis indicates that EBITDA margins are anticipated to lie between 3.5 to 4% if we reach a 20% non-steel mix, which we are very confident of achieving by FY 2025. As our non-steel business is in a relatively nascent scale, there is significant operating leverage benefits that we may see in terms of improvement in profit margins as we see a more aggressive growth in our non-steel business. With this, I would like to hand over the call to the moderator for a Q&A.
Thank you very much. We will now begin the question and answer session. The first question is from the line of Dhruv Bajaj from Smart Sync Investment Advisory Services. Please go ahead.
Good afternoon, sir. Sir, can you please share what are your plans regarding the manufacturing business, considering it is a low margin, low ROC business riddled with steel price fluctuations? So do you have any rough estimates of the replacement cost of our assets and if selling off those assets makes sense? Or since we have opted for demerger instead of divestment, so we have some strategies in mind to turn around that business and increase the utilization levels.
See, currently we are barely operating at about 40% of capacity. One of the disadvantages of being in a merged entity where the entire focus was more on the trading and the marketplace business was that there was less focus given on the manufacturing activities. So we believe that now one of the clear thing is to revive the capacity utilization, A. B, whatever we do in the steel tubes, we can definitely manufacture some of the products which we can manufacture ourselves but currently buy outside. So thirdly, with a much, much deeper focus, we do have a lot of capacity to get into value-added products in our manufacturing facilities. So these are the areas which we would be clearly focusing upon to turn that around. I don't say it would be a dramatic improvement, but definitely we are targeting towards much better ROCs compared to what it currently is.
Got it, sir. That is very helpful, sir. And sir, if I understand correctly, the top management team will be separate in both the businesses. So is my understanding right, or?
See, as the top management, me as the managing director and as the founder of the group will definitely be a mentor for both the teams. However, we do have a very senior person in the current board for the steel business. So he will be 100% allocated for the steel business. I'm talking about the manufacturing entities. So his portfolio would be at a senior level to take care of the entire manufacturing activity. While Mr. Demerger, who has come into the business about 3-4 years ago, would be taking over on a day-to-day management part of the marketplace business that is getting spun off in the future. But along with that, obviously at the other senior management levels like the finance CFO, the company secretary, etc., there would be a team in place for both the individual companies.
Got it, sir. That is very helpful, sir. And sir, what is the cost of rental as a percentage of overall revenues in the building material or retail segment?
Sorry, I didn't get your question.
Sir, what is the cost of rental as a percentage of overall revenues in our building material or retail segment? Since we don't have any plans of adding any incremental stores in the retail segment, so I was just trying to understand if there is any scope of operating leverage to play.
Approximately around 0.5%. It will be approximately around 0.5% of the revenue.
Hello.
It will be approximately 0.5% of the revenue.
Okay, sir. And sir, a follow-up question is, how do you look at the new competition from the likes of Grasim and Dalmia Group, considering we don't have any major plans to increase our retail store count, given the strong SSG growth potential in our existing stores?
See, this is a very decentralized kind of a business where overall, if you look at building material space as a single shop or a single store or a single outlet offering such a wide variety of products, we as India itself, we are in a fairly nascent stage. So secondly, I would like to add that we have been amongst the, let's say, the pioneering people in this kind of business at trying to aggregate a much fragmented business and putting it all under one store or under one roof. So I think the bigger groups, of course, they have got deeper pockets, but we have seen some of them like the Dalmias in it for some time. We've also seen L&T in the earlier days or Ultratech coming out with multi-product stores. So we'll have to watch and wait. I think our biggest advantage is that we are very grassrooted. We've got some years advantage of trying to understand the kind of marketplace, the kind of customers who need very, very, let's say, very close attention and detail to handling it.
Got it, sir. And sir, if I can squeeze in just another question, then from an analyst perspective, two major risks that a company currently has are high concentration in southern India and high revenue contribution from APL Apollo Group. So how do we plan on tackling that in future, or do you have some other thoughts on this topic?
See, our presence certainly is there in southern India. There's no doubt about it. In the steel tube segment, definitely we have a lot of Apollo tubes form the major part of our steel tube component. So two things. One, definitely we do have plans to go pan-India. So that over the years, even the current, as we're speaking, we are opening a depot in Mumbai for our tiles part of the business. So we do have plans to go pan-India in the coming years. As far as and we are already present in Madhya Pradesh too, and Odisha also. So that is one part which we will be spreading definitely as we move forward. And coming to the Apollo focus, it's like I mentioned, it's largely focused on the steel tube segment, which is one part of our overall steel business.
Got it, sir. That is very useful, sir. Thank you, sir, for answering the questions.
Thank you. Participants, if you wish to ask questions, you may press star and one. The next question is from the line of Gunit from CCIPL. Please go ahead.
Hi, sir. I just want to understand what percentage of our own production was sold to our own marketplace, or did we have any other direct customers as well?
See, currently, because it was the same company, we try to focus most of our sales of the manufacturing entity through the marketplace. So, which was close to about 80% was sold through the marketplace. That is from our manufacturing entities. But as we go forward, there would be this sale would be focused largely going directly from the manufacturing entity to the outside world.
So what numbers did you mention? It was close to 80% was sold to the marketplace currently.
Yes, close to 80% was sold to through marketplace. Going ahead, it is expected to significantly drop.
Okay. And sir, in the earlier calls, you had guided about 20 to 30% CAGR for the coming 4 to 5 years, and to reach about 10,000 CR on consolidated level. So now with the demerger and with the streamlining of strategies and more focused strategies in both the areas, do you feel that we can grow faster than this, or do you want to give a realized guidance? Do you want to give a new guidance? Looking at the IRGC with this demerger.
We have given that CAGR for the next 5 to 6 years, certainly. As a group and as a promoter, there's no doubt that I would be encouraging the team to achieve the same kind of numbers over the years. But as it's now split into two companies, there could be a slight moderation on but we are a little more focused on the margin profile now in the marketplace company. So as a group promoter, definitely I will push the team for the same CAGR.
All right, sir. That's all from my side. Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and one. We have the next question from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Am I audible, sir?
Yes.
Yeah, okay, sure. Thank you very much, sir, for this topic. So first up, I wanted to understand what sort of capital is employed in your manufacturing division?
Just a second.
Around 400 crores.
How much?
400 crores. 400 crores.
400 crores, right?
Yeah.
And I think we are currently having 4 to 5% kind of a ROC in that particular business, right?
Right, correct.
And in one of the remarks, you did mention that we are targeting much better ROC than it's today. So any kind of aspirational range we have in terms of what sort of ROC we might target in maybe 3 years to 5 years?
It is a little too early to comment on this. So once because we are in process of setting a strategy and a turnaround strategy for the same. So as things progress on, or maybe closer to the year end, or say in another 6 months, you will get a better idea about how things will move on.
Okay. Okay, understood. But our thought process is clear, right? Once we have done this demerger, so one of the key idea is to kind of focus on this company and revive it and try to create value or add value to all the stakeholders in this particular company as well, right? The manufacturing.
Absolutely.
Okay, so that's clear thought process out there. Okay, understood. And in terms of, I think you also mentioned that now focus is more on the margin front. Now, I think earlier as well, we were targeting in the range of 3.5% to 4% kind of a EBITDA margin in your marketplace business. Now, this business going away, which were 1.5% to 2% kind of a EBITDA margin business, ideally your range of EBITDA margin that we target in here would be on the higher side. Isn't it?
Yes.
So what would be the aspirational range? I mean, can we aspire that we can aspire at least a 6% kind of a EBITDA margin in our kind of these kind of businesses, or is it little too on the higher side, considering the business model that we work?
Yeah. I think at present, I can give you very confidently that maybe in the next year or so, I'm talking about FY 25, we would be in the marketplace business close to around 4% at an EBITDA, up from the current 3%. Definitely in the years going forward, we do aspire those numbers to go to at least definitely to 5.
To 5% EBITDA margin by what, FY 26, FY 27? I mean, in what sort of timeline?
We'll aspire for that.
Come again?
We will definitely aspire to improve the margins as we go forward.
Yeah. So what, I mean, by FY 27 is what this aspiration would be?
Yeah, I think I would not like to give immediately futuristic numbers, but definitely the aspiration is always there.
Okay. Fair enough. I got it. And in terms of, you did mention that our CAGR focus remains same. I mean, this 25-30% now with a lower base, right? With this 700-800 crores kind of a top line going away into a separate company, so that same revenue CAGR we can look for at a base of
20 to 25. Definitely as an aspiration that will always be there. I mean, as to drive a company forward as a promoter, that would always be the target I would give my team. So yes, we would definitely as a combined picture try to grow at that pace.
That's it. And on a base of what now, 3,300 crores, right? And 32 to 3,300 crores now, the revised base for this your marketplace business. Hello.
3,900. See, again, as we realign our strategy a little, because we are aspiring to grow around 20%. Ideally, as Sir said, should be the target going ahead. But I hope we again don't want to commit to any numbers so soon.
Okay, so the CAGR that you mentioned is 20-25%. Is that right?
Yes.
20 to 25%. Okay. I got it. I think, yeah, that's it from my side. All the very best to you. Thank you so much.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Aditya from Singularity Investments. Please go ahead.
Hello, sir. This is an interesting development. Can you hear me?
Yes.
Okay. So, when I look at the manufacturing vertical that we are talking about, we are operating at a return on capital of 4 to 5%. But if you look at your other competitors or people who are in similar businesses, what's the return on capital that you think other comparable businesses generate?
So it can be around 10% if we see a few of our competitors, but currently due to a little bit of defocus, it is on a lower end.
What are the mistakes? I won't use the word mistakes, but what have we not done right for us to be operating at 4 to 5% return on capital versus, let's say, 10% or whatever that competition or competitive people in this market will be operating at?
I think in the last the last 6-7 years, I think as the marketplace business was rapidly growing, there was definitely a defocus on the manufacturing side and the processing side. So I think that itself has led to a certain, let me say, internally a slightly a defocused approach of the same. I think some of the points which I had mentioned earlier, the minute it is implemented as an independent manufacturing business, I think those points would get rectified, and definitely this 10% plus kind of an ROC could be easily achieved.
But even if we achieve 10% ROC, in effect, considering the cost of capital, we are still destroying value, consistently. So wouldn't you think that it's better to actually just shut down a business which is generating 5% return on capital?
See, we certainly would like to make also it's a legacy business. We are a 50-year-old company, so a lot of built up over the years, there's a lot of assets that get built up. So it's easier to just shut down. We would like to give it a game try and then certainly try and make a success out of the manufacturing business. Maybe we can think of a lot of other opportunities could emerge in the near future.
Would you think that, let's assume hypothetically, if you were to shut down, I mean, this is completely hypothetical. I appreciate that, this is a legacy business and you would not want to do that. But let's assume for a moment that we shut down the manufacturing business vertical. Would it affect the EBITDA margins and return on capital for the buildings marketplace?
Sorry, I didn't get the second part of the question. If we shut down hypothetically, you said something
let's assume for a moment that we shut down manufacturing steel and allied products vertical. I mean, I know you're not going to do it, but for a moment, let's assume. Would it impact the EBITDA and return on capital for building marketplace?
No, not. Because we have anyway demerged the both, so it is not going to impact the marketplace business.
I mean, to answer your query, the whole ideal or the vision of this demerger was to make building material marketplace an independent entity because of the high return and high ROCE potential it already had. Having said that, at the same time, there is a new focus management team instituted to revamp the manufacturing business, and there should be an improvement in the numbers which should be coming in the coming years on the manufacturing side as well.
Okay.
Aditya, do you have any further questions?
Not right now. Thank you.
Thank you. Participants who have questions may press star and 1 to enter the question queue. We have the next question from the line of Shrey J from Swan Investments. Please go ahead.
Hello. Thank you for so just had a confusion. Yesterday when we released the presentation, there we're saying that 100% of our business is getting demerged, where turnover of the demerged division is showing as 100% demerged. And today in the investor presentation, we are saying that about 700 odd crores is the manufacturing business top line. And if I just go back and read your annual report, last 3 years, sale of manufactured products number is about 100 crores, 127, 95 odd crores. So where is this 700 crores coming from? So just not able to get that number.
In the subsidiary financials, we did a total top line of 767 crores in FY23. So when you are doing the consolidation, so that will get merged into the total revenue. And as a consolidated figure, we are showing 4,000 crores in FY23. So what we did was, we are given the breakup of the manufacturing revenue and other building material marketplace revenue, we are given it separately in the presentation.
Okay. So sir, when we released the presentation yesterday, we are mentioning that 100% of the business is moving to the demerged division. So this sort of confused with that.
Yeah. So most of our subsidiary sales is done to the Shankara, which gets recorded in a standalone. So as a process of regulatory process, when we are demerging, the whole of Shankara standalone is getting demerged. So going ahead now, like Sir said, there will be more clear focus between the two entities, and the subsidiaries will be doing a lot more direct sales to the outside customers.
Okay. All right. So the 3 subsidiaries that I can see, Taurus, Vishal and Century Wells, so those 3 companies will now get demerged and will become Shankara, and obviously Building Products will become another company. Is that understanding correct?
Yes.
Okay. All right. Thank you so much.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Kaustav Das, an individual investor. Please go ahead.
Hi. So I just wanted to understand, what is the growth that you are looking forward to in the marketplace business? Like, I thought you told the previous participant that it will be around 20 to 25%, but I guess in earlier conference calls you had alluded to it's like north of 25%, like 25 to 30%. So why specifically do you see a decrease in the growth? Like, if the combined entity was growing at a more rapid pace, why will the marketplace grow at a slower pace?
See, that overall, I guess, initial guidance that was given earlier was on a basis of 5 to 6 years where we will reach going ahead. Here now, as this new strategy we have taken, we will be realigning few things, and we will kind of say check more onto, or say focus more onto non-steel and more value-added business. So while doing this, we will again see where we are lining up. But a consistent 20-25% will be certain will be a target going ahead.
Okay, but are we then revising our growth guidance downwards? That is what I'm trying to understand.
So it is not actually the revision of the growth guidance number. The company is continued aspiring to grow. Now, having said that, now since the company has been breaked into two verticals, the two verticals management independently is evaluating their 5-year growth plan, and there may be some revisions to the consolidated group revenues slightly here or there to whatever the plans earlier were. So as these plans are instituted and finalized, we'll definitely come back to you with the revised estimates.
Got it. Okay. Coming to the other question, so as you can see, the ROC of the manufacturing business is quite low, and if you aspire to make it up to 10% ROC, even then the cost of capital won't really make much sense. So why didn't you think of selling this business at to maybe some large houses at a good valuation and using that cash to fund your marketplace business model even more? Did the management think on those lines?
No, as stated before also, it is part of our legacy business, so we have not thought in that angle at all. We want to continue and try and give a best shot in reviving the same and have a turnaround. So we are, and in essence also the capacity utilization in the manufacturing has not been that great. So as we improve and have a strategic focus on it, we are expecting to bring down a bit more of a cost, and we'll see where we end up. So we have not thought in the lines of hiving it off.
Okay, and if you are able to turn it around, what is the return on equity percentage that you guys aspire to be in? You have some numbers in your mind, right? That if I am demerging this, that is where that will be the North Star. So basically you will have something on your mind. So can you share some details, what you want the return ratios to be for the manufacturing business?
See, that is something, because we have seen not a very great time on that particular area over the last few years. That is being worked on. Definitely we aspire to improve the numbers. Difficult for me to give you a futuristic number at this point of time.
Got it. Okay. Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of VP Rajesh from Banyan Capital Advisors. Please go ahead.
Thanks for the opportunity, and most of my questions have been answered, but just one clarification. In your building products marketplace, is it primarily a distribution business or you have your homegrown products as well? And if so, what is the percentage of revenue that is coming from those homegrown products or brands?
So in our marketplace business, we would it would be more of a fulfillment center business where we would have multiple verticals going from our centers. Right now, since we are a multi-brand outlet, we do have key strategic partnership with a lot of top brands. Our own private labels probably currently constitute around 4 to 5% of the overall turnover. We are looking to increase it, but only in very select segments like with Fosha Ceramica and tiles.
Okay, that's helpful. And what would be the return ratios for this business that you expect, let's say, 3 to 5 years out for the marketplace business? Because it will be very asset light, right?
Yeah. See, for the marketplace business, as even mentioned the presentation and going forward, year ahead also, we are looking at a ROC of 30+.
Okay. All right. Thank you.
Thank you. To ask a question, ladies and gentlemen, you may press star and one. We have the next question from the line of Piyush Gandhi from Cognizant Capital. Please go ahead.
Hi. Am I audible?
Yes, we're audible.
Yeah. Thanks. Sir, would it be possible to basically break up the revenue of the marketplace business in terms of how much of it is coming from B2B, B2C, or how much of it is coming from our retail stores? Anything on those lines will be helpful for us.
See, our existing retail stores, whatever revenue is there, obviously is going to remain with the marketplace. So that H1 numbers we have released before. So those things won't be changed. The B2B, B2C numbers, it's in a way a fulfillment center. So now I will have end customers also and a lot of, say, individual contractors and influencers also coming up buying. So those will be a little mixed. At the moment, I cannot give you an exact ratio, but we'll come back to you with that otherwise.
Is it possible to outline what percentage of our revenues are recognized through our retail stores?
For overall top line, say we had around 55% of revenue basis the H1 numbers. Those at group level, and those remain or those will continue obviously in the marketplace business.
So honestly, the idea was to understand how do we grow this business, as you mentioned, 20-25%. If you could help us understand, one way was to add more stores, but apparently it seems we are not keen on adding more stores. So how do we kind of grow this business 20-25%? If you could help us understand that.
So there are two ways we look at it. We feel that in the existing stores we have a lot of potential still left. We're also looking at adding more of non-steel product and more value-added steel products in our store mixes. So that would also improve the volumes and turnovers per store. And we feel that as we move into this more of a fulfillment center model, we would have a bigger volume coming out of each store.
We're opening some stores.
And we would also looking at opening a few stores in the coming years, maybe 2 to 3 per year, where we see good opportunities.
Okay. Is it capital intensive to add new stores? Given that we are looking at multi-brand outlets, multiple products, a storefront would generally make more sense, right?
So the model is an asset-light model, so I would have to get back to you on the exact numbers, but we are looking at an asset-light model for opening stores going ahead.
So, sorry, again, I'm insisting on this, but so is it that currently we are selling more to the other stores who are selling the product, or are we selling more to the end consumers who are consuming these products?
So this will be approximately around 3 crores to set up one store.
Okay, that's helpful. Okay. And on the question as to, are we selling more of these products are sold to the end consumers, or they are sold to other stores who in turn sell it to the consumers? If you could help us understand.
So we have around 60% would be to end consumers and influencers and so, and we do have a mix where we do sell to smaller stores across the board. As we said, we're moving into the fulfillment center model where we do have various omni-channel presence per store.
Maybe, and just one last question from my side. On the marketplace model, what would be the kind of debt, is there any debt on the balance sheet that will come to this business? The capital structure, if you could highlight, what will be the equity and debt on this balance sheet?
No, there's not much of debt, and the debt equity ratio will be more or less on the similar lines. It will be around 0.2 or 0.4.
Okay. Thank you. That's it from my side.
Thank you.
Thank you. Participants, you may press star and one to enter the question queue. We have the next question from the line of Parv Jain from Niveshaay Investment Advisors. Please go ahead.
Hello, sir. One question I had on this manufacturing line business. Sir, as you have mentioned, we are aspiring to achieve 10% return kind of figure. I mean, any ballpark figure you can give at what utilization level we can see this kind of returns flowing in?
See, the 10% we said is of the industry and of say similar competitors. Though we would want to eventually achieve that in a complete long-term vision, but first we want to have a clear strategy in place to how to turn around this, and we have to evaluate how our current strategy is giving results. So we will be continuously monitoring that and reshaping and say do necessary take proactive decisions and have a separate team who is focusing on reviving it. So then we will be able to come up and say an exact number or give you a futuristic number that where we will land up or at what time that can reach to say that % mark.
Okay. I mean, just to understand, I mean, what utilization levels are our competitors operating at? I mean, if we can achieve similar kind of numbers, then maybe we can also achieve that similar kind of return. Any figure on that?
About the competitors, I can't comment now, but about us, see, at times it is even as low as say 25-30% of the capacity level. So we are looking into the our existing setup and how we can remap it for what type of additions or modifications is required, how we can optimize the cost and say better utilize it, how we can use the production for our own materials wherever cheaper substitutes are available. So we are looking into various things and let's see where it comes across.
Okay, sir. And just another question on this marketplace business. So till now, our business model has been asset light on that front, right?
Yes.
So going forward also we are planning to do similar kind of expansion you mentioned. I just want to understand how much percentage of our revenues are coming from a physical storefront and how much is that from our e-marketplaces. Is there any figure you can share on that?
See, e-marketplace is fairly negligible. As we have said before, or Mr. Dhananjay will comment on that more. So most of our sales is coming from the physical front stores only. And we are taking an asset-light model only. So we'll be going for more, say, rentals model approach wherever we may be opening few stores. And
So currently our e-commerce and online platform serves as a discovery platform which helps us push customers to our offline stores, and it's currently, as I said, discovery. We are working towards making it itself in our own marketplace of solutions regarding building materials. We will have more information and we will be coming out with more details in the coming quarters and the coming years.
Okay, sir. That helps. And just another question, if I can squeeze in. What kind of SSG numbers we are looking at for this year?
So we are looking for a revenue growth only. So specific number we don't want to mention.
I mean, on this existing stores, what kind of revenue growth can we expect for this year?
Approximately around 25%.
Okay. Okay, sir, that helps. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Aditya from Singularity Investments. Please go ahead.
So normally, people do share when there is a demerger, like a separated P&L and balance sheet, over, let's say, current year and last year, etc., to give a sense of how things look for two different businesses in exact numbers. When would we be able to get hold of such numbers, sir?
So our appointed date is April 1st, 2024. It's a slightly coming date. Most of the cases or other demergers you would have seen it's say a previous half-yearly date, so basis which they would give. So closer to that, and Q3 we will be able to give more better indicative slip how things will be moving and how things will be segregating.
That's good. Okay. I think I just wanted to be sure that I heard it right, but my understanding is that the manufacturing steel and allied products, that the 767 crores that we see here in slide number 7, almost the entire sales is to the building materials marketplace. Is that correct, or did I hear it wrong?
Yes. So overall, if you see, even if you see our balance sheet that we have been disclosing in the past, so our standalone top line would be coming around, say, 4036, but the consolidated figure would be coming around 4029. So most of these revenues, approximately 80 to 85% of the revenues are sold to Shankara, the marketplace.
Okay. So about from the 2,900 crore order of steel that is sold, let's say, I don't know the number, but let's say 700 crore versus through your internal unit and 2,200 crores is, what you may be buying from somebody else, some other steel mill or whatever it is, and then reselling. Do you see differential in margins over these two, between these two vendors internally?
See, at a group level, this anyway, consolidated level, margins will get nullified. So, and it's more or less around the same lines that we have disclosed in the presentation also. So it is around 1.7 to 2% range. It varies. So on a case-to-case basis, and the product for the different product ranges and offerings. So that's one of the reasons why going ahead we want to say independently try and keep it separate and ensure that all the sales and independently that entity will, so that it can get evaluated.
Oh, sorry, I think I could not explain my question. My question is that when you do an internal transfer pricing for the 767 crore of your own production unit to your retail channel versus buying the same product somewhere outside, is there a pricing differential in your system? Is there a pricing advantage that your internal unit gets?
Yeah, see, it is done at the arm's length only. There's not a huge difference in the margins there between what is done to outside and what is inside.
Got it. Thank you.
Thank you. Ladies and gentlemen, you may press star and one to ask a question. We have the next question from the line of Kaustav Das, an individual investor. Please go ahead.
Hi, I just had two questions left. So, how is the fulfillment center different? I just wanted to understand. You guys are talking about fulfillment, so I'm just curious.
So when I say fulfillment center, we talk about it's a place for retail, it's a place for our trade, for projects, as well as customers coming and picking up e-commerce orders. So it would be a multi-point center where we can cater to different verticals of business from our stores.
Okay, understood. Okay, and just one bookkeeping question. Can you provide what was the revenue growth for the marketplace business last year over year, and what was the growth for the manufacturing business, so that we can understand what was the growth rate for the individual segregated businesses?
Just give us a second.
Yeah, sure.
The manufacturing growth was around 20%, and marketplace was around. Yeah, so marketplace growth last year was little steep because of that.
See, the marketplace growth last year was, if you compare it between 22 to 23, it was almost 67%. So it's a very, very high growth. But that was because we started on a post-COVID low base. So I think that should not be a number that you should look at. So I think this 20% kind of a CAGR is a very fair number to look at as we go forward.
Okay, got it. And last question is, all the types of, all the other type of manufacturing ceramics that you guys were starting, Fortia ceramic and tiles, those will be moved to the manufacturing business, or will they be a subsidiary of this marketplace?
So in Fortia ceramics, we're only doing tiles, just to clarify, and it's contract manufacturing. It will remain with the marketplace business.
Okay, it will remain with the marketplace business. Got it. Yeah, thank you for my sake.
Thank you.
Thank you. Ladies and gentlemen, you may press star and one to ask a question. The next question is from the line of Suryansh from Bizex Enterprise LLP. Please go ahead.
Yeah. My question was what I was seeing the presentation. It seemed that we are very much focused on omni-channel presence. So I want to ask that does it make sense in such sophisticated product where the most of the transactions happen physically, and aren't we diluting the effect of the investments by diversifying through the contact points? So shouldn't we focus on physical front, and when the times arises, then we should be focusing on that omni-channel presence?
So we're not diluting any of our focus, and I would say omni-channel is more on the different modes which a customer can reach us. So one would be the physical store, one would be through our discovery platform, it could be through our social media, it could be on phones. So there are various ways for customers to reach us now. And our physical presence is our strength, and as you know, 95+% of revenue comes from our physical presence. So I don't think there's any dilution in that, in the focus. We are just looking to add more avenues to increase our sales.
Okay, and one more question is we have demerged the marketplace business and that manufacturing business. So are we looking to induct a manager with good track record in this retail or marketplace or something? Are we thinking about that, or we'll be doing ourselves only?
There are few things in pipeline. We cannot comment on those now at the moment.
Okay, thanks.
Thank you. Participants, you may press star and 1 if you wish to ask a question. The next question is from the line of Madhur Rathi from Counter Cyclical Investments. Please go ahead.
Thank you for the opportunity, sir. Sir, when we are talking about our private labels, where we have 4 to 5% of our sales from the marketplace, so what kind of margins do we have in these segments?
Around 12 to 15% GP with our private label, and as I said, we're at a nascent stage, so currently our revenue is lower, so our expenses are a bit higher, so our costs are higher. As we scale up, we will see a better return on our investment.
So 12 to 15% gross profit, is that right? And sir, in the manufacturing space, sir, who would be our closest competitor, in the similar kind of product that we are manufacturing as well?
In the manufacturing part of the business, we've got multiple things in the processing unit. Like we've got color-coated roofing, profiles, we've got cold rolling, we also manufacture some steel tubes, etc. As far as all these, the competitors are very many in number. Tubes, of course, you can take, people like APL Apollo itself is a gigantic unit. Of course, we're very small, we don't have a direct competition in line with them, we make different kinds of tubes. So you have many units in this field. It's not one or two. Profiling has become, again, very many are there. So I think it's a very well scattered and disaggregated kind of manufacturing line. It's more of processing.
Okay. Thank you, sir.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1. The next question is from the line of Kaustav Das, an individual investor. Please go ahead.
Okay, one more question. So, APL Apollo is also coming up with a mart kind of a model, right? I think SG Mart. So, what is your relationship with the same? Will they be a competitor, or is it a more of a symbiotic relationship? And if it is, how?
See, SG Mart, to the best of my understanding, is going to be largely an aggregator of steel products, which will be sourced at various levels, and it will be more of a distribution business of a much larger scale. So I think we are looking at more of a retail model. We are looking at a much more, more customer-centric in terms of end-user-centric kind of a business. So I think there will be more of a symbiotic relationship rather than a competitive nature.
Symbiotic as in will you guys be procuring from SG Mart, or just trying to understand?
Absolutely. The prices are good, we could buy from them.
Okay. Understood. Yeah. Thank you.
Thank you. Ladies and gentlemen, you may press star and one if you wish to ask a question. The next question is from the line of Aditya from Singularity Investments. Please go ahead.
Sir, I have been actually following your company for last 2, 3, 4 years, and I think you guys have done an exceptional job of cutting down the stores and then coming to a stable store count and then increasing the revenue per store. I think you have kept it stable at 90, 91 stores, whatever the number is, for like at least 4 or 5, 6 quarters. I mean, maybe more than that actually, 2.5 years now. Now, so what happens typically in the retail channel is that, once, you keep it constant over time, those stores mature and their revenue per store keeps increasing, and there's a point after which typically in retail, it's difficult to grow without opening new stores. Now, the direction we are getting from the management is that we probably will open like a couple of stores or some number, which will be much less compared to your current number of stores. If you are standing at 90 today, 2 will not matter. It's another 2% in terms of increase in square feet. And that is where, and then you have already matured your stores over the last 2, 3 years by not adding anything, any store at all, or maybe 1 or 2 odd stores. That is where, I think what the listeners are not clear on, how would we achieve this revenue growth rate with mature retail channels, so without adding stores. If you could just help us understand, that would be great.
Sure. See, the first thing is that we have diversified our product range. See, earlier many of the stores were very steel dependent. Now we have, in the last 6, 7 years, added a much wider range of products. So there is a huge runway of growth in the new products that we have added. Today, as we have been mentioning, our non-steel barely constitutes about 10 to 12% of our total revenue. So now with the focus is on the non-steel, we do understand that there is a huge headroom in many of our stores to take the growth further. Number 2, we have had a pretty good SSG. Even in the last year, it was around 39%. So it was 50+%, which itself is a great number to track. Thirdly, our experience in the earlier years when we opened a lot of stores, maybe a little recklessly, we found that we had to also close them down to optimize costs, etc., etc. But having said all that, to justify why we are not opening stores very rapidly, of course, one more point I can justify is when, probably we meet in person, I can take you through maybe a couple of stores which are reasonably mature, but which have also grown spectacularly in the last couple of years. So that is having said all this, it's not that we are not going to open more stores. We are fully conscious of the fact that a mature store after a point of time could start declining in terms of its utility. So we are very acutely aware of that. Right now the strategy number 1 is to push our existing stores so that we minimize costs, squeeze out the maximum for the buck in the existing stores. Luckily, we have achieved that with most of our stores the last couple of years, the post-COVID strategy that we adopted. But we do have plans. It's not that we are not going to grow stores. We are going to open them carefully, and we have a very clear plan that in the next year we would be opening definitely 3 to 4 stores at various centers.
Okay, sir. Thank you.
Thank you. We have no further questions, ladies and gentlemen. On behalf of Shankara Building Products Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.